Welcome. This is our first online newsletter for 2012 and we hope it's of some value to you in your practice. 2011 was an interesting year. A lot of things fell. Governments, interest rates, share prices and even property prices. Consumer investment confidence was down too. There were crazy gyrations along the way, and the international forecast for 2012 is still a cause of sleepless nights, underpinned by the euro crisis and continuing Middle East unrest. But there are signs of improvement as 2012 starts. The USA's growth figures are looking better, unemployment is down. China, India and other Asian countries are doing very well, and domestically employment levels are good and interest rates are falling. We basically still live in an economic paradise compared to the rest of the world. But to be frank, what happened last year and what happens this year and what happens 10,000 kilometres away should be of little concern to doctors, except of course for the human interest element. Your income is substantially underwritten by the government and there's a shortage of doctors and too many patients. The sky is blue. If your financial profile is set correctly, it's what happens over decades that matters, not years. And our advice to you ensures that your financial profile be set correctly. Our advice is summarised in detail in the client-only section of our website. If you've lost or forgotten your password, let me know so I can send you a new one. We suggest you take some time to look at the website and see what we're saying and make sure you're following our lead. If you're concerned that anything is not being done properly, please make an appointment to see a McMasters director as soon as possible. Speaking of director meetings, over the last year or so, all completed accounts and tax returns have been reviewed by directors and accompanied by a short summary letter setting out our areas of concern and potential improvement, together with an invitation to sit down to make sure that everything is going as well as possible. Two out of three invitations are taken up and good work is done, but I confess to concern about the 1/3, and if you're in that 1/3, I recommend your affairs be reviewed soon, at least once a year. And if we haven't seen you, please make an appointment for a meeting, whether at home or office. These days, most of our meetings are by teleconference and Skype. We're finding it very efficient. Last week, I had a Skype conference with a practice just 10 kilometres from our office. It went for spot on 60 minutes, covered all relevant topics, was followed up with a short form summary letter, and neither of us spent time in a car or waiting room waiting for the meeting to happen or close. It was super efficient, and it's good for the environment too. The annual director meetings have become a feature of our practice and are a critical component of our service to you. I confess to finding it frustrating when clients don't take up the invitation to meet. It's a rare meeting that does not kick at least one tax goal, and most kick several. The results over the years can be dramatic, so please make sure you meet with us at least once a year, if not more, and that you are doing all you can to minimise your tax liabilities and maximise your wealth position. By the way, we enjoy the meetings, and it's always good to catch up and see how things are going. The property market. We remain very positive about Melbourne's Bayside properties. We are biased, we live in Bayside and we know it very well. Nearly 10,000 migrants arrive each year in Melbourne, and Melbourne's the fastest growing city in Australia. The new arrivals are mostly well educated and well shod, and they want to buy homes. They particularly want to buy homes in fashionable suburbs close to schools and other amenities. The Bayside market was pretty much stable last year, down a little, but remember share prices fell by about 15% across the board. So overall, down a little means not that bad. But we're not actually interested in those short-term fluctuations. We're interested in long-term trends. And a long-term trend is for Melbourne's population to increase by as much as 2 million, from 5 million to 7 million by the year 2030. That's about 100,000 a year, each year for the next 18 years or so. This increase in population will see Melbourne's housing prices increasing significantly as well, and the prices in the fashionable suburbs will increase even more. Yep, there'll be dips and plateaus, but the long-term trend line will slope upwards, and housing is a safe and sound investment. You can touch it and feel it, you know it's there, you know no one's going to nick off with it, and you know you're not going to wake up in the morning and find that it's disappeared. In the shorter term, the tax efficiency of negative gearing and capital gains tax concessions, remember there's no CGT until the property is sold, and even then it's normally only 50%, make owning residential property an effective investment strategy for doctors and other high income earners too. If you're looking at a particular property in Victoria and New South Wales, let us know the details. We can get RP data price summaries for you for free. Those summaries set out the price history of the property and all relevant comparable sales. There's no fee for these reports, it's part of the service. Interesting ideas with residential property include gearing and self-managed super funds. This first came into being in 2007 at the time of the GFC. We were very cool at first because of the high cost of money and the high cost of the lawyers. But that's changed and it's now emerging as being a fairly good strategy for doctors, particularly those in, say, their early 40s with high living costs and not much ability or willingness to borrow for property. We can bring the superannuation monies into the equation and that really helps the borrowing ability along nicely. Helping kids into the property market or even grandkids sometimes these days, good idea. We have a number of strategies which help you do that. Owning properties in companies and paying off the loan with dollars taxed at just 30 cents, not 45%. It's a good idea as well, and it means debt reduction is better and faster, and overall the strategy is less risky. Remember our mantra, you should never sell a good property. Time's proven it to be correct, and we don't think time will disprove it in the future. As to the share market, we were cool on the share market last year, and this turned out to be a sound approach. But over the next 20 years or so, we're not cool at all. Building up a blue chip portfolio over the next 20 years should be the name of the game for each and every client. The real question is when to start, and there's actually some suggestion at the moment that that may be soon or even was last month. Interest rates are falling, and by historical international standards, Australian dividend yields are very high. We retain our preference for index funds and similarly diversified investments. Buying Australian-based investment in index funds each month makes sense to us and will probably prove to be a very sound strategy. But focusing on cash flow positive shares in specific industry could make sense at the present too. Have a look at the big banks. Yields of up to 8% plus franking credits, which equals excellent cash returns of over 10 or maybe 11% per share. Over 20 years, these should be very good buys. Think about what structure it should be in. Self-managed super fund, a company or a trust. Each has advantages or disadvantages, and one may suit you more than the other. Superannuation. We've had good results with self-managed superannuation funds. Last year in June, more than 30 clients took up our pre-30th of June offer to set up a free SMSF in July 2011 with a $600 fixed fee for the 2011 and 12 year. That fee won't be payable until sometime March 2013. Most of those clients rolled out of what were then low-performing industry funds and moved into fixed deposits with their favourite banks, such as the CBA, paying 5%. A low-cost 5.5% from the CBA beats 2.5% from Health Super or Hester any day. That strategy looks to be very good. We've got some very happy clients. It's not just the extra return, it's also the extra comfort from them knowing exactly where their money is and being in control at all times. Some clients had bad results with contributions to industry funds in 2012, inadvertently over-contributing and running into draconian penalties with the tax office. Management indifference from the industry funds didn't help. I confess we got very frustrated dealing with them. They really didn't care about their members. As a result, we've become a bit more cool on industry funds. They can be good, but the lack of control and putting your money with someone else who may not have your interests fully at heart can give rise to problems, and it did so last year with some clients being hit hard with tax penalties for really very minor mistakes. Our advice is always that a doctor should pay the maximum amount of superannuation every year. For a single doctor, that's $25,000 a year under age 50 and $50,000 over age 50. If you're married, as a practical matter, the amount doubles because it's not difficult for a doctor to arrange his or her affairs to be able to superannuate a spouse as well. With the cutback to superannuation contributions under the Labor government, we've been looking hard at other ways to get money into superannuation. Some ideas include superannuating spouses, as discussed, superannuating children, superannuating parents in some cases, putting away large non-concessional contributions, often coupled with special gearing strategies to get a deduction on the practice side of things. It's interesting, but a married couple can actually put 1.2 million into superannuation as a non-concessional contribution between now and July 2012. Notice I said July, not June. It relies on next year being included in the equation. Practice premises and self-managed funds are getting a lot of attention, and this coupled with gearing can make a lot of sense in some cases. An SMSF for a doctor is a low or no tax way to build wealth, and that's the name of the game. Build up as much wealth as possible in a tax advantaged environment. You'll get more after-tax return than otherwise, and that compounds over time, snowballing to become a very large amount. Tax planning. Our tax planning strategies have pretty much remained the same for 2012. It's all about the structure. For both your practice and your investments, practice trusts are best, PSI trust for PSI practices, and family trust for solo business practices, and hybrid trust for group practices. On the investment side of things, of course, in some cases companies may work better than trusts, and of course self-managed super funds come into play too. Getting the structure right means you will pay less tax than otherwise, and this translates into a higher after-tax rate of return. This year we're paying a lot of attention to unpaid distributions to companies from prior years. These amounts are technically not loans under the general law, being separate trusts, but they're deemed to be loans for the purposes of Division 7A of the Income Tax Assessment Act. The Commissioner's flagged that he's going to have a very low tolerance or even no tolerance approach this year, so we're making sure that those loan accounts are paid out either with cash or by dividend, and there's a unhappy third option, in some cases documented carefully as loans under the special rules. We don't have any exceptions to this rule. It's a hard rule we're applying. Some clients have expressed concerns, but I've pointed out that it's really should be a glass is half full, not half empty approach. These strategies have worked very nicely to defer tax for a few years, but the bets are off. The Commissioner has released a new ruling, takes the grey away, and makes it clear that he will take action against people who breach those rules. We're also paying very close attention to interest deductibility. This is of course a feature of our work. We take great pain to make sure that as much interest is deductible as possible. We're in particular triple checking to make sure that the actual checks paid to third parties are such that the rules for deductibility is satisfied. Again, the ATO has released a draft ruling setting out what I'd call, most are calling a fairly aggressive approach to this area. The various professional bodies are disputing the draft ruling, but in the meanwhile, we're not silly. We're reading where the Commissioner has come from and working hard to make sure our clients are in, in the right spot, or in safe havens, and everything that is done properly. Now, these are things we're thinking about at the moment, but nothing beats a meeting. I go back to the beginning and stress that it's all about meetings. We want to see you at least once a year. Ideally, this is with a fresh set of accounts and tax returns in front of us and a fresh understanding of your profile. But it can be at any time that suits you. You should definitely not hesitate to contact us by email or telephone whenever you're contemplating a major move in your practice or investment profile. Even if it's as simple as buying a new car, you'd be amazed how getting the tax right can make a difference. Best wishes for 2012. We look forward to seeing you soon. Chair McMaster.